The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. And now, please welcome your hosts, Mark Longo, Mike Cavanaugh, and Eric Cott.
Welcome to the inaugural episode of The Advisor's Option, our latest show here on the ever-expanding Options Insider Radio Network. And we're taking a little bit of a different tack with this show. We're going after a very interesting and growing segment of the options audience. Of course, I'm talking about financial advisors and wealth managers and asset managers and all these, quite frankly, gatekeepers to quite a few assets out there that are still not participating in as large numbers in the options world as all of us here think they should be. My name is Mark Longo from the OptionsInsider.com, as well as most of the shows here on the Options Insider Radio Network. And I am joined for this inaugural episode of The Advisor's Option by a motley crew of contributors. Starting off to my right, some of you listeners may know this voice from his infrequent appearances on the Option Block. He is Mike Cavanaugh from Know Your Options, Inc. Mr. Cavanaugh, welcome to this inaugural episode of the program, sir.
As always, a pleasure to be here, and just very excited about being a part of this great new cast of characters in the option world.
And quite the cast it is. And of course, we do have a new audience for this program. I'm sure many of the listeners of this show have not heard your very scintillating forays on the option block. So why don't you give our listeners here a little overview of your history in the options and derivatives business, and then what you guys do over at Know Your Options.
Absolutely. I got started in the industry in the late 90s, 96, 97. I was a commodity trader at the Chicago Board of Trade. I traded,
won't hold that against you,
commodity futures and commodity futures options. Migrated off the floor and into the retail space in about 2003, and up until recently, about October of 2006, which we recently just celebrated our 5-year anniversary.
Did you have this long-awaited party you've been talking about?
So it happened to just be me going, I guess it's been 5 years, and I got an email from one of our clients saying, haven't you been in business 5 years? No, we didn't.
You can do the party after the actual anniversary.
Yeah, we might have the 5-year, 2-month, 3-day party. But we started Know Your Options in October of 2006, and Know Your Options is a state of Illinois registered investment advisor, where we focus on hedging equity portfolios and using options to hedge them. Hence the title of the company being Know Your Options.
And we are also joined on the program here today by an old friend of the Options Insider Radio Network, Eric Cott. He is the Director of Financial Advisor Education over at the Options Industry Council. Eric, welcome to this inaugural episode of the Advisor's Option, sir.
A pleasure to be here, Mark, as always, and to be with my colleague Michael, as well as you, and I'm excited to kick this off.
Yeah, it's exciting. I know we've been banding about the idea for quite a while, and now it's finally coming to fruition. It is exciting. But of course, same thing as Mike. You know, some listeners may be familiar with you from your other appearances on the radio network, but we do have a new audience for this program. So explain to our listeners out there a little bit about your background here in the space, as well as what you do over here at the Options Industry Council and your advisors initiative.
Sure. Thanks very much. My history in the industry is a little bit over 17 years in a couple of different capacities. I was on the institutional side, but the majority of my time was at a wirehouse firm as a financial advisor and a branch manager. and fortunately came over to the OIC a couple of years ago to start an initiative which all of the exchanges at the time felt was the most important, which was to educate financial advisors about using options with their clients. So over the last few years, through our website and outreach at conferences, as well as doing research, the OIC has now expanded out to wealth advisors, although we have been reaching out to retail clients institutions for many years. The wealth manager side has been very difficult to penetrate, and we feel now there's a lot of reception on that side. So what my role is to just sort of, as I refer to it, be the preacher, the minister, and the rabbi of options. But we are agnostic here. I spread the gospel every day, and it is a wonderful gospel to preach.
And that is the MO of this program as well. We are here to spread the gospel of options amongst the financial advisor and wealth advisor community, to discuss the benefits and implementations of them, as well as some strategies and ideas you may use to add them to your own practice, as well as some of the benefits they convey to both to you and to your clients. And so without further ado, we're going to roll into our first segment, our CE segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to our CE segment. This is the portion of the program where we will sit down around the table, and it quite literally is a round table today, so that works well for our purposes. And we will break down some of the topics and strategies and talking points and terminology you may encounter as an advisor when first diving into the world of options. There's a lot of terminology out there. I know a lot of people can be waylaid or turned off by all the various minutiae of the options world. So it's our job here to explain it to you in a nice and simple capacity. And before we even dive into that, I know, Eric, you guys over here at the OIC have been doing a lot of interesting analysis and studies about advisors and their adoption and their use of options. And so I think you have some interesting data points we probably should share with our audience before we dive into the actual educational topics as well.
One of the things I probably should start off with, Mark, as well, just for our audience, is who is the OIC? So the Options Industry Council was created about 19 years ago with the sole role of educating the public about the practical use of listed options. We fast forward to today, we have an outreach to institutions and now financial advisors. So as an agnostic educational outreach, we want to make things, as you had said, simple, easy, and where advisors can implement this in their own practice. So what we have talked about over the last couple of years at the OIC was no one has done a quantitative study of option use by advisors, because I think the industry, the derivative exchanges, the firms have always felt that financial advisors aren't using options. And if they're using them, what are they using them for? Speculation. Well, we debunked that myth by releasing a study. The OIC commissioned an outside research company, Bellamy Research, to do a study of about 650 advisors across all channels. So we had a very broad-based representation of the financial advisor community. And what came back was quite startling. And I think it was startling a lot because we released the study. You and I were together.
I know it startled me when you released it down in Savannah.
You actually fell out of your chair.
I did.
I was amazed by that.
I still have a little twinge in my elbow there where I heard that. But by all means, startle our listeners as well. And if you are driving, listeners, please pull over to the side of the road lest you suffer the same injuries that befell me when I first heard this.
Don't do what Mike does and multitask. Please.
Sit down. Take a seat.
Put your seatbelt on. Thank you, listeners. One of the key aspects, points of the study that came out was that options have somewhat gone mainstream, and that the benchmark study found roughly about 48% of advisors reporting using options at least once in a client account in 2010, and a third of those had planned to increase their usage the usage going forward. So what we found also is that advisors who have a larger book of business, over say $500 million, have used options at least once. And the other interesting fact that came out of the study is that a lot of the conversation was client-driven.
That's one of the things that knocked me out of my chair when I first heard that, because one of the pushbacks we always received from advisors for years is that if I ever bring up derivatives, the D word with my clients, that's it, they're out the door. Right. So the fact that the clients are now the source of that demand is quite a flip. That's probably a lot of that can be traced back to what we've seen in 08, 09, and people realizing, wow, there's might be an actual use for some downside protection and some of the hedging aspects of derivatives. They're not all evil.
Well, the interesting thing, you use that D word. We try a lot when we're out in the field, and Mike and I have been on panels together, and you and I, Mark, have talked about this. We really kind of separate that derivative word and go back to the advisor and say, look, what's a way you can discuss this with your clients? Risk mitigation, risk management. That's really where the client can grasp it with them. And so
I prefer to confront it head on and just embrace the word and all of its negative connotations.
Just put it right out there on the table.
But to each their own.
But, we have been doing studies with individual investors over the last 20 years, and that's our Harris study. So the correlation now with this new study, this quant study on advisor use of options, they both go hand in hand. And I just think clearly what the message is that advisors didn't believe their clients were using it. Clients are using it. We're taking that to the firms. And now the message to advisors is that you can't ignore it anymore. You brought up 2008. I mean, we all remember that third quarter with Lehman and Bear and AIG when, you were a deer in a headlight with it as an advisor, not knowing what to do. Had you been discussing options, whether it was protective puts on an insurance side or even where there's no yield out there, talking to your clients about covered calls, that was just bringing something to the table rather than just holding your client's hand and doing nothing.
I mean, when you're just long only and your only options, pun intended, are stay long or get out of the game, your options are limited in that scenario, So these long-only managers who confronted that found themselves, like you said, deer in the headlights back in 2008 and 2009 when the market took a bit of a dip.
Well, again, I would sort of quote my colleague, Mr. Gocki, and say, when non-correlated became correlated and your only safe haven was cash, you needed to figure out what else you can do for your client. So I think that 2008 scenario created a lot of interest. And a lot of interest on the part of the financial advisors say, look, I really need to go back and figure out another way and another strategy and something else to talk to my clients about.
Sure. Well, and it's like Mark pointed out, the option was created to hedge risk. So right now what you see in the marketplace, a client-driven demand for an instrument that hedges risk just tells me that the underlying fundamental in this is there's a desire by the client to hedge risk. That person is going to find a way to hedge the risk. And if you're the advisor that doesn't know how to use the instrument to hedge that risk, the client will find the person to help them or learn it on their own to hedge that risk. That's it, the fundamental need. Listed derivatives, there's the D word, listed options have been around since 1973. The option contract itself has been around for centuries. Where people have gotten in trouble over the course of the years is when they use this instrument to hedge risk as a speculative tool, and it creates a bad misnomer. But the fundamental need is absolutely ever present, more now than ever, to hedge risk. And the clients driving that, they're saying, help me understand how I can hedge my portfolio. This buy and hold thing sounded good. It looked good. I was looking at how much I could make in 7 years to retire and buy the nice piece of property in Kaanapali Beach with my Ferrari and the helicopter that I buy to drop the Ferrari into my beach house in Kaanapali. No, but that's how people got introduced to the stock market over the last course of the 30 years. And, we've had some pockets of volatility, but nothing in our lifetime like we saw in 2008. Peak to trough here in the last 2 months, we saw a 20% drawdown, but that's still nothing like 2008. It reminded us of 2008. It's reminding people that, hey, if I have a fundamental need to hedge risk, if somebody in the advisor world isn't going to help me, I'm going to figure out how to do this on my own. So to the advisors, hey, smell the coffee, get an understanding that an option is not a risky tool. It's a tool to hedge risk, and the fundamental need to hedge, it's there.
And Mike brings up a great point because, again, I think that the advisors who continue to ignore it, they're going to see that their clients are going to go elsewhere. Yeah. And I think clients have become very savvy. And, on Mike's point as well, it's hedging, but we also find that a lot of advisors are using it as an income-generating tool. Because here we are. I mean, I don't know where you can find this. I don't see it anywhere at the banks. I mean, are you seeing 3% money market accounts out there?
Not unless it's in a 30-year.
Yeah. That is true. That is one of the perceptions of this show and in all the efforts you guys have been doing is really designed to combat that initial, like you said, avoid the D word because it gives that connotation of being risk additive as opposed to reducing risk. And that's, I think, one of the first roadblocks and perceptions and hurdles you have to overcome when dealing with advisors is that they come to it with all the negative connotations and baggage that options and derivatives have brought with them for years, that they think they're going to bring this into their portfolio and their clients' portfolios, and it's going to add risk. When, quite frankly, all the ways we're going to talk about on this show and all the proper usages that you talked about, Mike, really are there to mitigate and reduce risk. And once advisors wrap their head around that and come over that obstacle, we see them coming down the other side of this relatively quickly and realizing the additive benefits. And you mentioned, Eric, too, in such a competitive field. I mean, any given large area is going to have a large number of financial advisors competing and vying for the same customer base. And if you can be the one advisor on the block or in your area who can add some sort of options component to your marketing, to your shingle, saying, hey, I understand these, I can use this as a risk mitigation tool, that sets you apart from the crowd in an increasingly competitive field where maybe some of the other competitors down the street are still using that long-only mentality, and either they're in or they're out, and that's pretty much about it.
And one of the things about the study that we've done over the last 20 years, the Harris study on individual investors, is that those are the type of clients an advisor wants. A study always comes back every rolling 5 years. You've seen it before, Mark, and I know that Michael has, that these are affluent individuals, highly educated, and open to risk mitigation strategies. I mean, that's the type of client you want. So, and one of the other things we talk to advisors about is that, clients couldn't just go out and buy a stock or a mutual fund without any pre-qualification. The interesting thing about the options world is that a client has to receive the characteristics of risk disclosure document, the ODD, before they can even start to trade options. So I think that that's another comfort zone for an advisor to know that they are pre-qualifying, discussing with the client. And they both need to, the client and the advisor need to be on the same page to understand that there's a risk reward with any investment.
Before we move on from the study and dive into some of the educational bits, where can our listeners who want to read the full study, where can they find that on your site?
Absolutely. If you're like me, who feels that sleep's overrated, and I say that all the time, we're 24/7 on our website, so you can go on at 3 in the morning instead of watching Gossip Girl, which Michael likes and he tapes it at home. You can go to www.optionseducation.org/advisor, and you can register there. It is an advisor-only site. We do have 2 other portals for institutions and individuals, and that's where the study is, and easy to find on there.
And I think a lot of advisors will find a lot of those bullet points and talking points in that study very helpful for themselves when discussing derivatives or options with their clients and some of the uses and reasons why they want to bring these into their portfolio. But now we've been talking a lot about options here in this CE segment. We haven't actually discussed what an option is, and I know when I was discussing the potential for this program with a variety of advisors over the past few months, all of them continued to ask, can you please have an options 101, an educational starter kit, if you will, for options and what these products actually are. So let's just dive right into the nuts and bolts of it then. A lot of advisors, when they come to options for the first time, they have a lot of preconceived notions from their history as a long-only equity manager, or perhaps they trade fixed income, or they're used to buying products where they have a tangible piece of something. They own a piece of a company, they own a piece of a debt to a company, things that they can wrap their heads around. Where options tend to fall outside that a little bit, and that usually is one of the early stumbling blocks that a lot of advisors, and quite frankly a lot of retail customers, have when they're first coming to this product. It's a very ethereal concept. The option is a right, but not an obligation to buy or sell a specified security or underlying at a specified price by a specified time. And so once customers come to that and they encounter that for the first time, and advisors as well, like I said, there usually is a little bit of an impediment. You see that as well, Mike?
Absolutely. It's what we're trained, it's what we've learned the stock market to be. And you grab anybody off the street, 90% of the people view the stock market as a binary process. You buy a stock, it goes up, you make money. You buy a stock, it goes down, you lose money. I don't know how many times in the last 15 years I've heard somebody call me. You can see the light bulb go off over the phone, and they say, did you know you could short stock? So some people don't even know that you can short stock. So in a binary market, when you add a derivative, an option, which trades on the binary, but there's different moving parts of that option, it becomes a little bit more complex. So you're finding people that are just finding out that they can short a stock in the retail world. And you say, here's a call. You own a call when the market goes up to X point, your strike price. In X period of time, you have the potential to make money. You have to buy a call. Well, you could buy a put, and just buying something where you could benefit on a downside move is counterintuitive. So there's 4 things going on. You're either long or short the call or put, and then it's a call or put. So one goes up, the call, one goes down. One's value goes up when the market goes down, a put. So you take the binary away, and you make it 4 moving parts, and there's 6 things within those moving parts, the 6 factors that affect the options price. So you've got derivatives on top of derivatives. It's confusing. So what you have to do is you have to take one deep breath, a step back, pull over to the side of the road, and just think.
Once again,
right?
people are not getting anywhere listening to this show. They have to keep pulling over every 5 minutes.
Yes, call your home and say you're going to be on the side of the highway for the next 3 hours.
DVR. Well, get the MP3. Listen when you get home for your safety, listeners. No, take a step back. I always try to put everything into layman's terms. If you're a doctor, you don't get out of high school and open up a shop, put your name, Mike Cavanaugh, MD. I'd have to go to undergrad. I have to go to med school. I have to do a residency, 7 years and however many 6 figures of college and residency. Then I can call myself a doctor. Well, it's the same thing in the options trading world, the options investing world, whether you're an individual retail client or you're an advisor. There are barriers, entry barriers. The same in the medical field, the same in the rocket science world. They might not be as visible, but they're there. And you can't start trading the old, gamma scalping vol, IV, HV, short-term stuff.
That's episode 2.
Yeah, that's episode. Well, we might touch on that after I tell you what a call option is. No, you have to start at the beginning, and you have to learn that this is a nonlinear process. It's not linear. It's not binary. It's nonlinear, and you don't start shorting options. You don't start using leverage in the portfolio until you understand the relationship between the stock and the put, the stock and the call. Learning the synthetics is a great place to start.
And for this purposes of this episode, we're going to keep it super simple. We're just even going to discuss, really, I think, the long aspects of buying options, because that usually seems to be the easiest place to start with most newcomers to options. When you start getting into the short aspect, you start talking about a short put, then the mind starts to be blown in certain occasions. But we discussed certain aspects. Mike used the terminology of calls and puts, but we haven't even really gotten into those yet in terms of what a call and a put is. I know a lot of our listeners are sitting here saying they've heard those terms. They're not really familiar with what they are, so we'll start off with the basics. Like you mentioned, a call is just a contract that gives you the right to buy an underlying at a specified price by a specified time. The put is the flip side of that. It gives you the option, pun intended, to sell a specific underlying at a specific price by a specific time. So once you wrap your head around those 2 very basic concepts, then you have a good starting point for the world of options, because those are pretty much the 2 flavors. That's chocolate and vanilla when it comes to options, is calls and puts.
Yeah, the calls and the puts and the rights and the obligation. And you and I have done this before together, where you kind of bring things down to layman's terms and the analogies, and you're more than happy to share those the analogies, because it is that simplification where the advisor understands it. And then we always say the best way to do it is try it for yourself. So on the calls and the put side,
before you put your clients into it, you're going to want a level of understanding. So not even getting into the obligation side of it, just the right. When you own a call or when you own a put, you have the right to decide. There's no obligation. You can choose to exercise or not exercise. So there's so many different ways when you learn, like, you got to make it linear. Even though it's nonlinear, now we're talking about you have the right. Well, when should I exercise a call? When should I exercise a put? The first thing you have to do is you have to sit down and you have to physically go into your account with your own money, $500, and purchase a call. Write down on a piece of paper, and I won't go into the 6 factors of options pricing, but just write down on a piece of paper to start where the price of the stock is on the close on Monday, and where the price of the stock is on the close of Tuesday, and look at the price of the call, and just write it down. Then that's your first start. That's your building block. And if you're a computer programmer, you can put that in Excel, and I'm sure you don't have to physically write it down. I'm just saying you got to start somewhere, and you have to look at the change in the price of the stock and what happened to the option. You're going to start noticing things. If you did that for 10 days, you will have data, I guess we could call it, that you'll start noticing
you'll have
things.
pricing history, I guess.
That was an uncomfortable pause. You'll have some data, and you'll start noticing, well, hey, the stock went up, and my option, the call option I own, didn't go up. Why?
Our number one question on the Options Insider, to this day, by the way, is still that question.
And it should be, rightfully so. If you're just learning it, that should be the first thing you notice when you start writing this thing down. Don't jump into the deep, dark, murky waters first. Understand, make the water clear, write it down. Put it in the spreadsheet. Look at the price of the stock. Look at the price of the option and why it changed, how it changed. And then you can start peeling back the layers of the onions and saying, why? Why did this happen? Why didn't my call appreciate in value when the stock went up? And once you start gaining that level of understanding, that's like your first year of med school. Why did that gentleman's heart stop beating? What you have to start looking at it from, well, I'm just guessing you had a, blah, blah, blah. No, you have to know why. And the only way you can get to know why is you have to start at the fundamental, which is you own the call, start tracking the prices.
You can already tell Mike you're going to fill the colorful analogy role of this program.
I've been known to have a couple colorful, kind of in the trenches too. I mean, I'm out there doing it. So, I've worked on the retail side. I've worked with advisors, and, we walk them backwards. We don't say, hey, we're going to start doing, 6-legged calendar spread. No, because you can't. You have to start small.
Yes.
We don't learn how to multiply in algorithms or base 10 logarithms. You learn 1 + 1 when you're in first grade. For some of us, like Mark, he was doing 1 + 1, 3 months old. But
yes, a little
like
bit,
1
little
+ 1, 1 - 2, whatever, 4 × 4. You start learning incrementally linear. And you have to break down options that are a nonlinear, non-binary vehicle, and you have to make them linear.
So let's break them down then in those component parts that we were talking about. You're an advisor. You're just listening to this show for the first time. You're thinking to yourself, okay, I have a basic concept, the vanilla and chocolate, the calls and the puts. And we talked about risk mitigation earlier. But why, if I'm an advisor that's coming to this for the first time, why would I adopt these tools? What benefits are they bringing to me? And one of the first, and probably one of the most important benefits for a lot of advisors out there is the leverage that an option can bring to the table. Particularly when you're talking about on the long side here, which is what we're focusing on for this program. When you're buying a call, when you're buying a put, they afford you a substantial amount of leverage far beyond what you could traditionally get with a typical just purchasing and trading the underlying itself.
Well, and I was going to add to what Michael was saying. The simplistic point of it is that, and you just touched on it, is why would an advisor embrace this in their practice? They're doing asset allocation. They've invested in mutual funds or ETFs. So why would you use options when you have assets in a client's portfolio? And I guess the point that we try to bring across to advisors is that there's so much volatility. There's so many, markets are moving all the time. And if you're buying something for your client outright, you could see that stock go down in a given day, and you've just put all that money out. So to step back, why would you use a call? Why would you buy a call? Well, because you're not having to put that outlay of money
exactly
for that.
From a capital management perspective,
Absolutely.
Which is what a lot of advisors are concerned with these days. I mean, if you're putting in underlying positions or equity positions, you're tying up the full amount, or you're doing it on margin and tying up 50% of the amount. But that's pretty much the limits of the leverage that you can access if you're just limiting yourself to the underlying, to the equities themselves. Whereas with options, they bring a far larger degree of leverage to the table. And this is where we're discussing primarily equity and index options for this inaugural program. We can get in some others, ETF and commodity options down the road. But for the purposes of this initial inaugural episode, we'll stick with equity options, I think, which is the interest of a large majority of our audience. And this is where we start to get into some of the terminology, which I think is important, but could also be a little bit confusing. When you're talking about leverage, options come with a multiplier. And this is where you start to lose some people for the first time. We're first learning about this. They think of an option. They see an option is trading for $1. Well, that must be cost me $1 to buy that particular, let's say it's an option on XYZ stock. My favorite stock. I'm sure it's your favorite stock as well.
I always so long XYZ.
It's a road to retirement right there. XYZ,
is
nothing but
the widget company.
I mean,
that's the one that invests in widgets, or no?
It would be trading at $1 million for how many times you see it in the public spot. Like, it's always advertised everywhere.
It is a multinational, and it has a lot of different parts.
But we're talking about an options on XYZ stock, and whether it's a call, let's stick with the call because the call is easier to understand, I think, than a put. The call gives you the option to buy that XYZ stock. Now, one call option, if you purchase it for the proverbial $1, it's actually going to cost you $100 and not one. And that reason for that is because every option contract is actually for 100 shares of the underlying stock. And that it sounds complicated when you first think about it, but it's actually a relatively simple concept. That is what's known as the multiplier of the option. And all equity options primarily operate on that same 100 multiplier. So now we look at the price of that option, which is trading for $1 on XYZ stock. And we say, well, we can buy that for $1. That $1 is then multiplied, hence the multiplier, times the 100 shares of stock you will get if you exercise that call. let's say XYZ stock is trading at 100. You want to buy the 100 strike call, then you turn around and pay $1 for it. You're actually paying $100. Now let's contrast that. We're talking about leverage. Let's contrast that to if you're buying the underlying outright. You either buy 100 shares, the similar amount to what you're getting with the call. You're going to pay either $10,000 if you buy it outright or $5,000 if you buy it on margin. But that's pretty much the limit of your leverage. Whereas you're putting on a roughly equivalent position. We can get into Delta in a minute and talk about how Delta might mitigate that a little bit, but a relatively equivalent position on 100 shares of the underlying, and your outlay is only $100. Well, obviously, we haven't gotten into time and all the other components that go along with that, but that's the basic outline for why options are so valuable as a leverage tool for advisors who are coming to these products for the first time.
And hence how options have been deemed or have gained a connotation of being too risky. I kind of make analogies and I put names on things. And in the retail world, as an advisor, I've dealt with all types of individual personalities, and I tend to bulk them into two groups, the make-its and the keep-its. The make-its are the ones that are going to look at that scenario that Mark just explained. I can pay $100 to have upside exposure in this stock, or I can pay $10,000. Why don't I pay $10,000 worth on the 100, and buy 100 call options? Buy 100 call options, still $10,000. That's where we see the options getting a bad name. If you don't add that over-levered capacity to it and you use it as a tool to replace the upside for a lower cash outlay, that's what they were created for. They weren't, I'm going to spend $10,000 on the stock. No, I'm going to spend $10,000 on the at-the-money call because if it goes up, I could have a 6,242% return in 3 days right before expiration. That's how people were introduced. And when they are introduced that way, what tends to happen is they tend to lose money. Then they they go to the barbecue on the weekend and they tend to tell their friends, like, I went to this option seminar. He told me I could make 6,248% in 3 days. And they showed me a list of all the winners that they had in the last 2 years. They didn't go into any of the losers, but it just gives the industry a bad name. It gives the term option a bad name, and that's not what it's all about. What it's all about is take one step back. Call it caveat emptor, buyer beware. We were just talking about the options disclosure document not too long ago. Maybe we should put something in there that if you've gotten this far in this document, you can have a free steak dinner. I can't see the audience, but by a show of hands, how many people have actually read that? I have, and you should. It goes through, honestly, all the risks of buying and selling a standardized option. Start there. We're talking about starting out right and buy one. Start by actually physically reading that document to understand the risk. And I have a propensity to ramble there, so if I didn't answer the question directly, the answer is
I'm just thinking about the steak dinner. That's where my mind's
that's where you've already lost him. He's already planning Gibson's
exactly.
Gibson's
I'll
Bonanza.
take my medium rare.
But of course, there is a bit of a contrast there where we're talking about risk management and the use of options as a risk management hedging tool. Yet we're starting off with leverage. The reason we're starting off that way is when options and advisors are first coming to this, that is one of the initial tools. They're going to buy one lot of a call instead of buying the stock, and that's how they're going to get comfortable with it. And of course, the leverage also works to the other side, which is of course the puts, where you can do the protective side, and we can get into that in a minute, I think, as well. But we've hit on calls and puts now, so we've hit on multipliers, so we've hit on a couple of the basic terminology that advisors will be seeing when they first come to the options market that maybe make them a little weary, a little concerned. There are other terms, I think, obviously, that are also important. You mentioned the time to expiration. That is, I think, another key stumbling block that so many newcomers to options encounter. And that $1 option we were just talking about in XYZ stock, it's cheaper than the underlying. One of the reasons that it is cheaper is because options have a very fixed lifespan. Your bet or your hedge will only last for the lifespan of that contract. They will expire, and then if your option has moved in your favor, it will expire with some value. Otherwise, it won't. And so that concept, I think, is another one that is very new to, like we said, buy and hold advisors. They've been trained to buy and hold. That time to expiration is non-existent in that philosophy. Same thing with a lot of retail who have been trained over the years to buy and hold their favorite equities. How many times have you heard from a client or an advisor, the stock moved against me, now it's a long-term hold? That's the mentality. You're still holding it, you still have the same position. Maybe you add some more when the stock's a little cheaper. You loved it at 100, you got to love it at 50.
You average down.
Exactly.
But instead of knowing you have the flexibility with options, as you said, you could have a 3-month contract, you can have a 6-month contract, and I think that flexibility one of the beauties of options.
Flexibility, and also, like I said, there is that finite lifespan. So when you're first encountering options, you're going to see them and be like, I can put on this hedge or this stock replacement strategy instead and buy these calls, but then your bet has to work out within that finite amount of time. So getting a handle on that and that concept is typically another thing that stumbles a lot of advisors. And then, of course, when we're talking about timed expiration, that inevitably leads into probably one of the scarier things that people first encounter when they're first coming to options is the Greeks. People hear this name, they see these very scary mathematical symbols being thrown around at them, and they say, okay, that's it, I'm done. I thought these things were kind of crazy and risky, and now they're throwing math notation at me. I'm just going back. I'm going to buy Coke and hold it, and I'm going to be a happy guy. Or XYZ stock, as the case may be. And so these Greeks, they're much more intimidating than they actually are when we actually use them in the options world. Their bark is worse than their bite, is probably what I'm trying to say. And what we mean by the Greeks, so these are the four main variables, the four main components of options pricing. So if you're a professional options trader, these Greeks are hammered into your head from the moment you walk on the floor. And the Greeks break down as delta, gamma, theta, and vega. And that sounds very silly. It sounds like I'm naming fraternities. But that is essentially what the Greeks are. And I think we'll start off focusing on delta because I think for a lot of our audience, for advisors and for retail, the delta is where they hang their hat. Delta is what a lot of them come to these with directional strategies. They're not doing what we talked about with gamma scalping a vol position. They're not doing that yet. They're coming to it with a very directional sense. And so delta is the prime driver of direction in an option. And what delta really means is just it has a couple of connotations, obviously, but we'll stay with just the pricing connotation for now, because obviously this show is just an overview of what you need to do. We could spend many days in here discussing all the topics. And if you'd like to learn all these things in detail, by all means, go to optionseducation.org. There's a lot of great information there, as well as the optionsinsider.com, and even a little bit over at Know Your Options Inc. as well, where people can find more of this information. Mike, you seem like you're ready to dive in here, so I'll let you run the delta a little bit before I keep going.
I mean, delta is a simple, the rate of change.
Well, this gets into your concept you were talking about before about where the call moves as the underlying moves, and that is delta in a nutshell.
The first part, yeah. So the first part, and this is where you should start. And you're going to, maybe it's all right to lose a little money when you're first starting on 1-2 contracts, even a virtual trading apparatus where you're not physically losing real money. But delta measures the rate of change of the price of the option for the first $1 move of the stock. $1 up, $1 down. So if the stock XYZ is at 100 and you have an option that's at the money with a delta of 0.50, if the XYZ stock goes from 100 to 101, your option will gain by 0.50. If it goes from 100 down to 99, the options price on a delta aspect will be affected by a negative 50 cents. So that's it. That's what delta is as far as how it affects the price of your option. So what you need to know is at the money, in the money, out of the money, what your delta is. The further you go out of the money, the smaller your delta gets. The deeper you go in the money, the larger the delta gets, and it tends to be when you're close to the money, it's around a 50 delta.
We probably should hit on those terms then too before it at the money, in the money, out of the money. You're jumping way ahead of me, but let's just do it. Let's go right down the list. These are obviously more terms you're going to hear when you're encountering options for the first time. Mike gave us a primer on them, of course, which is at the money, in the money, and out of the money. And at the money, in the example we just used, would be XYZ stock trading at $100. The 100 call would be the at the money. That's where the stock is currently trading right now. And then you have in the call aspect, let's focusing on calls right here. Unless you want to run with out of
calls,
the money, in the
calls
money.
Are fine. Out of the, we
I don't
can
want to
even call it moneyness.
we'll let's go with moneyness.
Patent
there we
it.
go.
Yeah, we'll call it moneyness. The moneyness of the option.
The money ball.
The in the money, if XYZ is trading at 100, the in the money would be a 50, a 60, a 70, a 10. In the money, deep in the money. In the money means the strike price of the call that you're purchasing is lower than the value of XYZ stock trading at 100. So anything below 100 is in the money. Mark pointed out that the 100 is the at the money, and then anything on the call side trading above 100 is out of the money.
Exactly, and then we can really scare people by talking about the put side and flip that entirely.
I actually feel like I helped somebody out there right now that did not know the term moneyness or what in, out, or at is.
Yes.
Yeah,
they started the car up again, and they're driving
home
home
know what in the
saying,
money is.
They know
Mike
ITM,
Cavanaugh,
OTM, and ATM. That's all they need to know.
Then they hear ATM and they pull over and they go to the ATM.
Yeah.
To go to the steak dinner. So which they've now read the whole prospectus.
So you hit on at the money, in the money, and out of the money. We've hit on delta, which is going to be your primary driver of a lot of your directional strategies. I think we'll skip gamma because that one's just a wee bit out there. I think for a lot of people coming to this for the first time, maybe that can be show 8 or 10 where we get into the rate of change of delta. And then another one, I think, which we talked about the time aspect of options. Another one that's really going to, another Greek that's really going to play into a lot of the strategies that advisors and your clients choose to employ is, of course, theta. Theta measures the rate that an option will decay over time. That term decay sounds pretty terrifying, sounds pretty scary, but it really just measures and quantifies the fact that your option has a finite lifespan. And every day that your option approaches that expiration point, a little bit of its value is going to decay off. And theta allows you to measure and quantify that position. So if you have a position or a lot of positions across your customers' accounts where you're long a significant number of options, theta will, looking at your theta on a daily basis, will tell you how much it is costing you to hold those options on a daily basis. So theta, for a lot of our listeners and our audience, and particularly when we get to the short side of options down the road in episode 2 or 3 or whatever, when we're talking about selling options, theta right now, if you're buying options, is your enemy. When you're selling options, theta will become your best friend in the world. Eric,
I can hear the screams by you saying selling options.
Yes, we told them to start driving again. Then we threw another wrench in the works.
They just drove in the ditch right now.
Yes.
Send all of your accidents claims to
Mayans
OIC. They're saying to their kids in the back of the car to cover their ears.
Yes.
As soon as Mark mentioned theta. Well, I think you said it eloquently, and I think one of the points is that for the advisor, the Greeks can be overwhelming and your eyes can go up on top of your head, but you need to understand that. You know, the analytics of an option contract are critical because, as you said, it's not like a buy and hold or a buy and mold. You can't just put a stock or an ETF or another instrument in a client's account and forget about it. You have accountability, and you have to watch that. But again, for the advisor and the client, going back to buying the call, what is the goal in mind? And the goal in mind, as we just said before, was not the outlay of all that money, the leverage of being able to own an instrument without putting all that cash out. And I think that's the simplest way for why the positive aspect of buying calls.
You can trade that equivalent underlying position, that equivalent, I'm using terms like underlying, probably should define that as well. The underlying, of course, is the actual instrument that your call or put is derived from. So if you're trading XYZ stock and options on XYZ stock, the underlying for XYZ would be XYZ stock itself. So these are terms we're so comfortable throwing around that we forget we have to define all of these aspects for that. But we mentioned theta. We should close out the Greeks with probably the king of them all, but for this audience, probably not as relevant yet, which is, of course, Vega, which measures the volatility impact of your portfolio or of your options position. So a given percentage move in Vega will, in turn, have a percentage impact on the price of your options. Like I said, we won't spend a lot of time on Vega right now. Right now, I think a lot of advisors and customers coming to this for the first time are going to focus on the directional aspect. Delta and theta will be the two components. I think we'll mention Vega so people at least are familiar with the term, I think, but we can come back to that down the road on episode 6 maybe or something like that.
Yeah, and what we've just done is, this is, I call it DTV, and it's not a television show. It's the piece of paper that I said, write down the price of the change of the option. Write 3 columns down when you're writing down the change in the options price and keep track of the change in the delta, the change in the theta, and the change of the vega. So you write down where the stock XYZ closed on Monday, where it closed on Tuesday. Then you write down the price of the option on Monday, write down the price of the option on Tuesday, and then write down the change in delta, write down the change in the theta, write down the change in the vega. What you'll start noticing is, hey, and this brings us back to the number one question, how did I lose money on the call option that I bought when the stock went up?
Right.
You will start being able to define those answers. Well, the delta was 3, the theta was 3. So even if it went up $1, I lost money because I was at a break even because the theta was the same as the delta and the vega went from 45 to 12. There's your answer. You'll start noticing that stuff. Some people, and the opposite is true. How could I be up money if the stock went down? Well, if the Vega was at 0.03 and it went to 300, you would be finding yourself in a position where you probably made money on an option where you think you probably shouldn't have. So DTV, write it on the piece of paper and start keeping track of it. Old school, get the chalkboard out with the chalk.
I prefer the Excel myself, but you can write it on a notepad if you want.
Because Mike and I can't afford what Mark has. So you can do it on a piece of paper or have the
Poor Eric
iPad.
has a sandbox in his office with an Irish walking
his
stick,
abacus
and
at
he
home.
writes in the sand with the stick. But whatever, an Excel spreadsheet, an iPad, whatever, just write those down and start watching it.
That's a good tip to really start getting acclimated to these terms and seeing their practical impact. I mean, people they learn delta, they learn that rate of change, and then they don't really appreciate what impact that has in real world terms. And you start watching these things and the actual real world performance of these instruments with the movements in the underlying, you start to appreciate things. And it will save you from having to email me or the site and saying,
Well, and that's what you do so eloquently,
Absolutely.
too, at Options Insider. You bring it
we
from
try.
30,000
Thank you,
feet down to ground level to try to
Thanks
get...
to all of our good contributors like our friends over at the OIC.
No, sitting here, I'm the advisor. I'm boots in the ground, boots in the trenches, whatever it is. The advisors listening to this show that are serious about their business, their livelihood for the next however many years, if they're a younger advisor, the next 35 years, you're going to take this seriously. There's a right way to do things. There's a wrong way to do things. The right way to do things is when your client sees this activity in his account, it's his money. He's going to have those questions, especially if he's an engineer that worked at Boeing or anywhere else. Engineers have a knack for options trading. They want to know why, and they don't ask. They find out, then they ask. So if you're an advisor, you're serious about your business, before you do this, you're going to want to learn because your client's going to see something you want to have that direct answer to say, I understand the stock went up and we didn't make money on that call option. Here's the reason why. Mr. Engineer, sir, client of mine, you're building a practice the right way. You better educate yourself. Your clients are out there educating themselves. So, from a practice aspect, it's very important to take that high-level understanding and fine-tune it down and, make it linear. Start slow and then ramp it up.
Well, here we are in this inaugural episode of the Advisor's Option and this inaugural CE segment. We've already gone for quite a while, and we've only just barely scratched the surface. We talked about the two flavors of options, calls and puts. We talked about some of the reasons why you might want to implement them, including leverage, as well as some of the scenarios you might find yourself in with our favorite underlying good old XYZ. We outlined some of the terms you may encounter at the money, in the money, out of the money, underlying, and all, of course, the very scary Greeks, delta, gamma, theta, and vega. We talked primarily about buying call options in this episode. I think we'll keep it there for now. If we add puts to this discussion, we're going to go another hour easily just on the other side of that. So
Screams
I think
once
yes,
again.
yes. So
Where's that sound effect?
we do need to add that. We'll need to add that to our board. But I think that will be maybe for episode 2 and beyond when we talk about the puts and the protective aspects they could bring to your portfolio. So I think that's going to close out this inaugural CE segment. And now we're going to roll right into our Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, and welcome to our inaugural Tricks of the Trade segment. This is the portion of the show where we give you advisors out there in the audience some practical tips for adopting and implementing options into your practice. And so as a perfect way to kick off this segment, I think you guys have done a lot of work over here at OIC on this precise topic, on some very specific tips and suggestions for advisors who are looking to get the ball rolling and start bringing options into their practice. So why don't you kick us off here with some of OIC's 7 simple steps for incorporating options into your financial advisor practice.
Thanks, Mark. One of the things about the brochure that we put out there was we were trying to keep it simple so an advisor could understand why there was a benefit to add options. And one of the things we always try to say is you need to speak to your specific firm because, there are advisors who might be with a wirehouse, an RIA, or an independent, and every firm has a different policy of what type of options an advisor could use, as well as some firms that, unfortunately, which we don't realize why, that don't allow their advisors to use options at all. But again,
it seems so dark ages in this day and age.
Well, we always say for a firm to have a policy where an advisor can't do something, why would an advisor want to stay there?
Yeah.
So,
well, that and how do you not allow them to do trade an option, but you'll allow them to sell an annuity, which are once again the problem of not reading through the 840-page prospectus.
Or trade a levered ETF or any of these other things out there.
If you've ever read the prospectus on annuity, you would find it's riddled with options. So not being able to trade an option and being able to sell an annuity is counterintuitive.
I think a lot of advisors probably, if they did their homework, would be surprised at how much options and derivative exposure they already have without even knowing it, and just a lot of the variety of the products that they already trade and sell for their clients.
And it's interesting you bring up the annuity, because we did a podcast a couple of months ago where, because so many advisors are using variable annuities, we say that you've used that with your client. How do you think the insurance company is hedging that potential down the road of the client switching on that living benefit, which is that income stream, that pension stream? The insurance company is basically using options, because they have to hedge their risk and that future income stream. So that's where that light bulb goes off occasionally for an advisor. But so what we try to do is we tell the advisor to identify prospects. As you are identifying people in your book of business that you're going to use to allocate their investments into maybe mutual funds, or ETFs, well, identify those prospects that would be appropriate to talk to about options. For example, it could be that individual.
Your proverbial engineer from Boeing is a perfect example.
They'll approach you. You don't have to worry about the engineers.
That'll be a long conversation with the engineer at Boeing. But the client that has come over maybe from another firm and has deposited a lot of money in a qualified account, maybe, and you're talking to them and they're worried about the swings in the market. They don't want to allocate all that money to that XYZ proverbial company that just came out with a new technology or something like that.
Why would you be leery of XYZ? It is indeed the best company out there.
It only goes up XYZ. But if your client doesn't want the outlay of all that money, so you identify some of those prospects, about talking about buying calls with them possibly. The other thing we talk about is, where are the best opportunities? And again, we talked in one of the prior segments about in the money, at the money, and out of the money. And so you're figuring out what is the purpose of adding an option strategy with the client. And so, are you on the same page, and does the client understand the risk and reward? What can happen at expiration? We with our brochure, we kind of wanted to keep it in a 3-tier approach, because we wanted to, look, there are so many strategies out there that can overwhelm an advisor. So we keep it simple. Look, we're in a zero interest rate environment today. How can you create a dividend on a non-dividend paying entity? The covered call. So we say we're in a zero interest rate environment. Potentially, we might be for quite some time. Looking at the covered call. Clients understand insurance. You want to, I guess you're there. You want to kind of remove that fear of what's going to happen in the markets. So you might bring up the topic of a protective put with them. And lastly, when you take the call and the put together, you have a collar, and we won't delve into that
You're
just
going
yet.
into like episode 15
We're
here.
We're going to keep that and backtrack for a second.
Screams.
Pull over again, listeners.
Turn the car
All
off.
these car accidents were
Turn the
I
car
can hear
off.
the squeals on the highway down the street.
But when we mention the collar, I think what is paramount to an advisor is that a lot of financial advisors around the country work or want to have corporate executives, as a client, because that's the affluent individual. And so utilizing a strategy with options to participate in some of the upside but protect the downside, and that's where the collar. So we really we summarize, and I think it gets the advisors thinking about how to implement a plan. It's like anything else. You sit down with a client to put a plan together about their qualified and non-qualified assets, and you're maybe talking about educational planning, maybe estate planning, things like that. It's no different than with options. You have to actually have a plan and figure out which clients in your book of business it might be appropriate for, because not every client is going to embrace it. So, again, it's a process.
It's absolutely a process. And, the advisors, it's a great opportunity to address it in your quarterly or monthly client reviews. You sit down and, we have topics on there, and a lot of times, those topics on there are like, would you be interested in a real estate mutual fund? Would you be interested in a commodity or a managed future? Just having the same conversation. Maybe none of your clients are interested in hedging risk. I would find it hard to believe, but maybe your book of business isn't. Just asking those simple questions as part of your quarterly, monthly, weekly, however often you talk to your clients, part of that review process saying, do you know what an option is? Have you ever traded an option? Would you be comfortable learning this as I learn it with you to find a way to hedge risk in your portfolio or add income to the portfolio? I think just getting it out there, there's probably an inherent fear by the advisor that doesn't want to do it because they're thinking, well, if I say I don't know what an option is, the client's going to...
There goes my client.
No, it actually builds a strength, builds a bond with that client that, hey, I appreciate this guy's looking out for my best interests. He wants to learn something with me and find a better, no pun intended, option for my portfolio.
And we see a value added because for the newbies or the rookie advisors that are coming into this business, this is a way to add something that makes them competitive.
Yes.
And for the advisor that has been in the business more than 25 years, they might not be utilizing it right now because they're staying on that path of that buy and hold, or they're looking at their asset allocation model, and they feel that it's worked. So if it's not broke, why
Yes.
there's no need to fix it. But it's that competitive edge. Individual investors are becoming much more savvy and educated. An advisor has never been more in a position like they are today, where their clients, at a blink of an eye, are thinking about maybe moving an account.
Yeah,
they're very vulnerable. That's what it is.
Yeah, very
The
empowered.
waters have never been murkier for the advisor. Never.
The more you can hang on your shingle to make yourself extra value added for the client, because the client, like I said, they're very mobile today. They can move, they can jump to their own brokerage house and manage their own funds. They can learn these products on their own, and then what do they need the advisor for? So it's critical the advisor get into that conversation before the client gets to that point and really discuss these topics, as Mike said, in this fashion. And Eric, you gave us a number of great teases for future episodes down the road about generating income, about adding your own dividend yield, about covered calls, about protective puts, about collars. These are all fantastic topics that we are going to get into in future episodes here of the Advisor's Option. But we want to keep conversation today just to the basics so we don't overwhelm our audience. But I'm chomping at the bit to get at all of those topics right now. And that's going to do it for our Tricks of the Trade segment. And now we're going to roll into our Industry Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
And welcome to the Industry Buzz segment. This is, of course, the portion of the show where we talk about some of the interesting developments that are happening in the world of options and, dare I say it, derivatives that may be interesting and will impact advisors down the road. And so I know Mike and Eric, you both have some interesting developments you want to share with our audience. So, Mike, why don't we start with you and some of the things that are happening right now in the world of options and derivatives and that are impactful and interesting to our advisor audience?
Yeah, it's something that we noticed in the past couple of weeks that we thought was very interesting. Earlier in the show we were talking about demand coming from the client side. Well, I think it was about 2 weeks ago, a company out in Oregon named PCA, which is Pension Consulting Alliance, or I don't know the exact acronym, but it's PCA. They're in Oregon. They have a client, which is a Seattle County Employee Pension Retirement System, which is about a $2 billion, that's with the B, $2 billion pension fund for the public employees in Seattle. They are going to do an RFI, which is a request for information for people that can manage a covered call portfolio, and they're going to do a 5% allocation. So an allocation coming from a pension fund, $100 to $125 million, that's pretty serious.
Nice
usually
size account.
An RFI, absolutely, an RFI comes out and it's the so-and-so pension wants a long-only value manager.
Yes.
A lot of times they won't look at anything that has an option. This company specifically helping this pension fund look for an advisor that manages a covered call strategy with the derivatives, with the D word in it. So it's very interesting. It's very exciting being in the space to watch a pension fund actively pursuing a covered call manager.
Traditionally derivatives-averse institutions and substantial money managers who for years have just stayed away from this game to be starting to allocate substantial resources toward this. And like you mentioned, this is a fantastic opportunity for advisors who are looking into this. And I think this is just a trickle of the deluge that will be coming into derivatives down the road as more and more of these large funds, especially look in the last month we've had with 30 handle moves in the S&P on a regular basis. More and more of these large funds who have been long only for so long and have been averse to derivatives are starting to realize the value of the hedging and the income generation something like a covered call can do. And so they're starting to allocate more and more resources. So that pension fund is a great example. I'm sure there will be many others down the road and far more assets chasing those handful of advisors and asset managers who have this specific knowledge set. I know, Eric, you had some other interesting examples you wanted.
Well, it's a great trend, Mark. I think that for where I see it, in my vantage point, working for the OCC, formerly the Options Clearing Corporation, and representing the 9 exchanges, we had record volume in August. I mean, I think advisors can go back to that second week of August and remember the major swings. And so we're not only seeing that record volume coming from institutions, we're really seeing it from the retail client. I mean, we've never been busier here at the OCC and the OIC, and also our investor services line, which is 888 Options, getting a little commercial in there for the great group that we have here at the OIC. They are finding that the volume of calls coming in during the week is just tremendous. And it's coming from retail clients, and now we're seeing a lot more of it coming from wealth managers. So, the industry as a whole is shifting a little bit, and we're seeing that, again, it takes time with wealth managers. I think they've always been selective on when they use a new product or a new investment. That happened with mutual funds years ago. It happened with ETFs. It's happened with anything else. But they see that sophisticated wealth managers around the country are using it, and these are advisors who are very successful. It ties in with that quantitative study that we did a couple months ago, that if you want to emulate a successful advisor, you really can't ignore options anymore.
Yes, I mean, that speaks to just the growing sophistication of this audience, particularly on the retail end. They're becoming increasingly knowledgeable, increasingly empowered to handle these instruments. A great example would be VIX. This was a product that was created solely for the purpose of laying off institutional volatility risk in the S&P 500 options pit, and yet this product has skyrocketed, some might say dangerously so, with the retail audience, but yet it has enormous awareness with the retail audience now, and that's something you never would have even guessed a few years ago. So the retail audience are coming to these products and embracing things that were traditionally the domain of institutions, and they're empowering themselves and they're learning of these products. You don't want your client to outpace you if you are an advisor.
And I think that's fearful of advisors.
Exactly.
Right.
Exactly. And so with so many of these retail customers coming to these products and embracing these topics and becoming much more knowledgeable in options, you definitely don't want your clients to move ahead of you, because then they will move away from you, quite frankly.
That's true, Mark. And one of the other things we see in the industry, and again, having a conference here in Chicago this week, is that a lot of asset managers, managed money, portfolio managers, et cetera, are looking at the opportunity to provide a third-party resource for advisors where they can take the fiduciary responsibility of maintaining the option contracts and find a third-party provider, whether it's in a mutual fund, an SMA, a UIT, an ETF, and you see a lot of this, Mark, with your audience, and they can use options, but they can do it in a third-party vehicle. And I think that's an exciting thing to see also in the industry.
So I think we gave our listening audience a lot to chew on, a lot to mull over in this inaugural episode of the Advisor's Option. This was just a brief slice of the overall options pie. As the show rolls along, we will be bringing to you a lot more examples of strategies. We'll get into the put side and
just
talk
a
about
taste, Mark.
Yes,
that was just a taste.
Just a taste
Just the appetizer
of all that we have to bring. But of course, Eric mentioned the covered call and the income generation strategies. There's a lot more to come on this program in terms of the different ways that you could take and incorporate options into your practice. And if you want to learn more in the interim between these shows, by all means, visit optionseducation.org, or of course visit theoptionsinsider.com, or even good old Know Your Options Inc. Mike Cavanaugh will answer any question you may have.
Just click on the stopwatch.
18-minute portfolio review. There we go. Maybe our advisors don't need that, but they could certainly
still click on it.
Okay,
it comes right to our inbox. Our CRM. Most advisors would know that term.
Yes.
And all the exchanges that we represent as well have great resources online.
So thank you for joining us here in this inaugural episode of the Advisor's Options, and we'll see you in episode 2.
The Advisor's Option is brought to you by the Options Industry Council. For more information on how the OIC can help you implement options in your practice, please visit advisor.optionseducation.org. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.